collateral ratio that is above the amount of the loan that you've taken, basically. It's basically the system manages your position. And every time somebody takes out a loan, there's a percentage of the value of that loan that gets paid to the people that are providing liquidity.
Okay. Well, hello and welcome everyone. This is Lakshay from ZEX Media, and today at the HODL Summit, which was formerly World Blockchain Summit at the Jumeirah. So, while exploring a lot of projects, a lot of different segments all around the blockchain universe, right? I happen to strangle my terms with Mr. Cristian, right? So he's a great mind and innovator in the blockchain industry. For past 20 years, he has his experience in how the loans works, how the blockchain works, right? He's been an advocate to blockchain and all the DeFi protocols, right? So you have a vast experience in this. And speaking of liquid loans, where you actually founded your current charisma, right? So you're the founder and CEO of Liquid Loans. First of all, let me just
co-founder. It will upset my co-founder if we say founder. I'm the co-founder.
You're the co-founder and the CEO. Yes. So you have like a team as well. Yes. Okay.
Absolutely.
So first of all, hi. How are you? How's
Fantastic.
it been going for you?
Yeah, really good. So today has been a very exciting day. I must admit it's interesting because the philosophy that underpins liquid loans is not something new.
Yes.
But a lot of people just, particularly in crypto, I think one of the comments that I made in the presentation is people presume that to extract value, they have to sell their assets, and that's not the case.
Yes.
You can actually hang on to your assets and borrow against them. And that's essentially what the protocol facilitates. It allows people to borrow against their assets rather than sell them. And the example I gave, which is quite a real one, was a friend of mine that actually, she basically sold 10 Bitcoin years ago to pay off a car loan. And at the time, it was fantastic. She did really well. But now you fast forward, and that particular example, if she had have hung on to those 5 Bitcoin, that at the time it was $5,000 is what it was for her, she would have had $800,000 worth of Bitcoin. So it's kind of, this is the
She
dilemma.
would have a bigger garage of another car.
Exactly. So it's a massive, massive loss. And it's purely because people presume incorrectly that they need to sell to extract value.
They should have seen it as an asset.
Exactly right. It's no different to saying to someone that owns their home, would you sell your house to buy a car?
No.
You borrow against the asset to acquire what it is that you're looking to acquire. It's no different in crypto, but you don't do it with every asset. The majors are important, but that is fundamentally what Liquid Loans is about. It's to help facilitate that for people that are interested in using their crypto as collateral rather than selling out of their crypto.
It's like you analyze the asset. You can sell the old car for the new car. But you don't sell the house for a car.
That's right. That's exactly right. You never ever do that. And if you look at the most wealthy people in the world, that's exactly how they live. They don't sell their assets. They borrow against them. And the only issue, however, is the asset has to continue to appreciate in value. And that's one thing that you need to be mindful of, is that, and particularly with crypto, assets tend to go up and down, up and down, up and down. So you need to manage your position. You'd never overextend. You borrow what you need, but you always manage your position. So what does that really mean? It basically means if the value of your asset starts to drop, you either have to put more asset into the bucket to cover that collateral, or you decide to repay some of the loan. So effectively, you're always maintaining what's called a collateral ratio that is above the amount of the loan that you've taken, basically. Does that make sense?
Yes. Yeah. So it's all about the equilibrium, right?
Yeah, exactly.
So making it the asset base, the principle that you have, and making sure it's in the right spot, right? So as the collateral and the principle that you have should be in an equilibrium.
That's right.
That's right. Talking about liquid loans, first of all, how you came up with this name? I mean, is it something?
I have to defer to my my co-founder. So Dave, the co-founder, and I sort of came together and we sort of debated what should be the name, and it just made sense to us that, hey, we're looking for liquidity and it's through a loan mechanism.
That's where I was going.
liquid loans. It makes a lot of sense. And some people sort of turn their nose up and say, oh, no, you should give it a cryptic name, and people are more inquisitive. But I'm a believer in, hey, you just, what it
Keep it
is,
simple.
what's on the tin is what you're getting. And it's just a way of obtaining a loan or basically extracting value from your asset without selling. That's fundamentally what it's about.
And you also have a 0% system, right?
And to be honest,
what exactly it is?
Yeah, so that's usually the one that just, you can imagine bank managers just flip their minds when they hear. Imagine going to a bank saying, "Hey, can I get some money but just don't charge me any interest."
they'll just say there's the dough.
Right? So effectively, what is this really all about? It's about community lending. Yeah, so there's a community of people that have acquired assets that decide, hey, we'll allow you to borrow. There's still a fee. There is an upfront fee, but it's not a huge fee. It's like 0.5% or something like that you pay to acquire the amount that you're acquiring. But there's no ongoing fees. There's no interest payment that's required. Okay. The only thing you need to manage is the difference between how much you've borrowed and what you put up as collateral. So if you, for example, if you put up $100 worth of collateral and you borrow 50, effectively the ratio that you have is quite high.
Yes.
So, and as long as the asset maintains that value, you never need to repay. Right? You never need to repay the loan, so long as the asset remains that. But we know that with crypto, assets go up and down, right? The value goes up and down. So it's not something that you can just do it and assume that it's going to be okay. What you need to do is just make sure that you're constantly monitoring, okay, is the capital that I've put forward, is it still maintaining enough of a value that covers the loan that I've taken? Okay. And so long as you're doing that, that's fine. And don't get greedy with it. And the other issue I find is, and what people forget too, is that, okay, let's just say that you put up $100 worth of an asset of some description and you've borrowed 50 and the asset drops to, say, $10 worth. What happens is the system automatically sells your position. So it will basically recoup when it gets to a certain level. Say it gets to $60, it'll say, okay. We now need to sell that asset
almost to the resistance.
To cover that $50, right? And it does that. It automatically does that. So there's no manual intervention. It's all on code basically that's doing it. And effectively it sells your position, but that $50 you still get to keep. And if the asset incidentally does drop further than that, the system's already recovered itself anyway. So it sold it at 60. But if the value kept declining, you're in a position to acquire more than what you actually borrowed. So effectively, or what you put up as collateral. Okay. So if it went to $10 rather than the 100 that it started at, the $50 that you've borrowed, you get to keep. No one takes that away from you. You get to keep that. And it just means that you've now got $50 to spend. If you wanted to reacquire that asset, you can reacquire it. Okay. And you'll get a hell of a lot more, right? So it's basically the system manages your position. But we advocate that individuals should be mindful of that and monitoring their position. No one wants to lose the asset, right? Of course. No one does. But the system will do it, but you still get to keep what you borrowed, basically.
Okay, and how about the community? I mean, they put their money for the lend pool, right?
That's right.
What mechanism is there for them?
How does the system work, basically? So there's people that provide liquidity.
Yes.
And every time somebody takes out a loan, there's a percentage of the value of that loan that gets paid to the people that are providing liquidity. Okay. So that percentage, depending on if you're providing liquidity, sometimes the returns for them can be 20, 30% on what they're providing as liquidity. Okay. So they're getting a nice return from that. And there is another asset or a token that's issued from the system that you can also use as a staking mechanism. So you can provide stability to the system and earn yield on that. It gets really complicated, but it's not really. Fundamentally, you've got to think of this is community lending. And people that are providing effectively what you're borrowing, they're looking for a return. And the system provides that. And it may not seem like a lot, but when you have a lot of loans being taken out and a small clip every time, that's enough to satisfy the people that are providing that or facilitating you being able to borrow, basically.
So there's a system, there's a single pool that's been funded by the staking of
That's right.
the community and being lended by the lenders.
So it's
and
community lending.
manages.
Yeah, and the community does make money. You know, it's based on if you borrow, you whatever that small percentage is goes to pay the community. And if you're a large person in that community, you're going to take the lion's share of that. So it is community lending, but the community does get a return, right? So it's not feeless. There's no ongoing interest percentage, but that initial percentage is enough to satisfy the community that's providing.
Just like the initial filing charge of any transaction, right?
That's right.
How about the platform? Is it live, and what changed?
Yeah, so we've been live on Pulse Chain now for nearly 2 years. We are also on testnet on Base, so layer 2. We are looking to roll out on a number of other chains. I think now in particular, given that Ethereum has just gone through some changes recently, that it has made it very deflationary and the transaction costs are a lot less. It's very appealing for us to roll out on Ethereum, and I think that's definitely on the cards. But fundamentally, that's the only other issue is transaction costs can cripple any chain. And to be honest, I think that's why there were so many layer 2s that started up against Ethereum, because the transaction costs were too high.
Yes.
So hopefully that changes, and if it does, then I think you'll see liquid loans on Ethereum as well.
Wonderful.
Yeah.
Let's talk about markets, right? As you've been into this whole ecosystem of blockchain for a very long, and being a DeFi advocate, so you know both the terms, like compliance and regulations, and the technological aspects. So how do you see both of them staying aligned, still keeping the environment safe? And
I think there is, without being political in my response here, I can understand why the regulators, it feels to me like they're trying to catch up. They're trying to regulate stable coins. But here's the dilemma. There's a geopolitical angle to this as well.
Yes.
And that is, if you look at Tether, for example, Tether's the major stable coin. It's a centralized stable coin, but it's still the major stable coin. And it doesn't comply with MiCA, and it isn't intending to. And I believe that it's now based itself in El Salvador. So there's a real tension around, well, who's going to have appropriate regulations for this to try and control the issuance of effectively US dollar denominated stable coins.
Yes.
And that, I think, is the challenge, because if you look at and I'm now getting into a lot of geopolitical, my view on this is that the US is trying to bring back the US dollar to effectively control US dollar out of the US.
Yes.
So this whole euro dollar thing, that's going to slowly but surely reduce. And I think that's the concern. So now, okay, let me give you another example. Tether is almost going to be seen as another country that can buy US treasuries.
Okay.
Right? Now, why do I say that? Well, because, look, we know that the US dollar, the manufacturing of the US dollar is a Ponzi scheme. Everyone knows that. And that, there's no hidden agenda there. That's the reality. The treasuries can be printed and dollars can be printed, and that will continue. But if any countries outside of the US jurisdiction want to try and do that, they're not going to be able to do that.
Yes.
And Tether permeates all countries.
Yes.
And most importantly, I actually think a lot of the smaller countries where they don't necessarily have the levels of controls over US issuance of US dollars, all of a sudden people in those jurisdictions can access US dollars via Tether. So you're going to see Tether being a very big player when it comes to issuance of US dollars that are backed by US treasuries. Right? I think that's how it's going to evolve. Now, what do? We're not competing with that. What we're providing is a stable asset.
Yes.
It's not whilst it's pegged to the US dollar, it's a stable asset. It's not a stable coin per se. And so, but it's still pegged to the US dollar. We're not out there to try and create a competitor to the US dollar. We're just allowing people to take something that's stable and use that in whatever way they require it. And it can be pegged to anything, but typically it's pegged to the US dollar.
And I'm like, after hearing this, do you really feel like this would be kept as decentralized as it should be, or
I think
is there
that,
something like the bigger fish is going to have the major control?
Yeah, I think that the reality is, I think centralized control is it's going to happen. With the CBDCs linked to something like Tether, I think that's going to happen. How does that impact crypto in general, particularly if there's a lot of advocates for complete decentralization, no control. And whilst I understand that, I'm very pragmatic and I think, well, no, there's a need for centralization in some respects, right? To try and protect some individuals. But the reality is that people need to educate themselves as well. And I think you're going to see an evolution in this space. And we're on the periphery. So we don't want to compete with stablecoin issuers. No way, that's not our game. Our situation is more about providing a stable asset that can be pegged to any of these dollars. So to answer your question, where do I see this heading? I actually think that crypto is definitely here to stay. I think it's now more mainstream. I mean, it's easy to see the narratives coming out of the US. The comments that Donald Trump has made around having a sovereign wealth fund that includes Bitcoin, includes potentially other assets. I think that's quite deliberate to say, look, we want to potentially have the lion's share of that market. And I think that's where I think it's heading. And I think the competition now is, okay, what's the EU going to do? What's the UK going to do? How are they going to sort of navigate this environment? And one example would be regulatory environments where you have the MiCA regulations in the EU, and then you've got, I think, what's it called? The Genius Act that's being sort of developed out of the US. And we know that Tether, for example, Tether's decided, well, we're not interested in MiCA. We're not going to look to comply. Okay. But they're heavily involved with the Genius Act, which says to me that, look, Tether's here to stay. Yes. And it will be seen as a very good way of issuing US treasuries because they have to be acquired, but people everywhere across the globe will be funding those acquisitions. And that reverts back to what I mentioned earlier about Tether being seen as almost like a separate country that can actually print dollars on the basis that it's buying the US treasuries.
And also there's no boundary for Tether.
That's right.
Wonderful.
Yeah.
There's a lot more to explore in the blockchain university. So stay tuned. Let's hope we catch up again because you have another sessions as well. So I'll just let you take the leave. And thank you so much for giving us the time
and
the
insights
that you gave.
Thank you.
It's wonderful talking to you.
Thank you so much. Bye-bye. Thank you.